Happy Thursday. It is January 27th, and today we are talking about the top headlines from the week, which include the future of funding markets, centralized crypto banking is becoming more competitive in Canada, the easiest ways to enter new geographies can be via acquisition, we'll explain, and our lightning round. Shoplazza raises 150 million US dollars from SoftBank, BenchSci raises 50 million US dollars, and Caribou raises 3 million US dollars. I'm going to bring up my co-host for the show today. You know him well, Alex Norman. Hi, Alex.
Hey, Alex.
Yeah, Alex. Hey, it's like an Alex squared.
Yeah, it's going to be very confusing. At least when I talk to Jason, people know who I'm talking to. But thank you. I think it's going to be a better episode with you here than Jason. Don't tell him that.
Oh, no. We'll have to tell him not to listen to this.
Yeah. And we've got coast-to-coast coverage. You're on the West Coast today. So
yes, I am. California.
Yeah, it looks a bit sunnier than it is in Toronto right now.
I can't complain. There's no snow, so lots to be happy about.
Yeah, excellent. So this is your first episode. Take it away.
First episode. Okay, so first up on the docket, we are going to be talking about the future of market or funding markets, the future of funding markets. So there's a few things that we want to hit on with that. Can you tell us what the news is? Maybe dive in a little deeper about everything that happened this week?
Okay, well, I think there's two very confusing things going on in the market for founders. One is the public markets have been unkind to tech companies since the beginning of the year. But at the same time, in the last week, we saw 3 VC funds announce new funds for the Canadian market or targeting the Canadian market. So let's maybe start with the public markets. In case you haven't been paying attention, the start of the year hasn't been that kind of tech stocks. So since January 1st, the NASDAQ is down 12% as of yesterday. Shopify is down 33%. Lightspeed is down 22%. Thinkific is down 27%. And I can go on and on. No matter what the results are, Netflix is down, Microsoft's down. The public markets are generally being all kind of tech and growth stocks. On the flip side, this week we've had 3 VC funds basically announce their intention to invest in Canada. So maybe I'll just run through them. Give me a couple minutes here because it's a bit longer than normal. So Mars IF announced a new fund called Graphite with $100 million focused on seed and A stage companies with 77 million closed already, 25 million from Ontario, 25 million from OMERS. They're going to be focused on Ontario companies. They're going to be focused on life sciences, software, and clean tech. So basically any type of early startup. And they're going to, IF is going to continue to do pre-seed companies in a different fund. So here's a new fund dedicated to Ontario, $100 million. Next thing is Deloitte Canada announced the launch of a $150 million fund called Deloitte Ventures. Very exciting name. They're going to invest in areas where Deloitte can help companies such as fintech, health and life sciences and cybersecurity. They're looking to invest in companies with product market fit and write checks of 2 to 10 million. And this continues a trend of corporate and new corporate VCs funds. And finally, you have Builder VC, which is based in San Francisco but has a partner in Alberta, and they've got a 250 million USD fund. They're focusing on what they call the untouched tech markets: agriculture, food, supply chain, industrial logistics. They invest in A stage companies. They're a U.S. fund that's taking advantage of the Canadian market by raising money from the Canadian government or Canadian provincial governments and looking for better deal flow, more affordable deal flow in Canada. So, one hand, lots of bad news. On the other hand, it looks like there's a lot of money.
Right. Now, of these, VCs that were announced, is there one that you're really interested in or intrigued in and would want to keep your eye on?
Well, so each has a different perspective and a different value. So, like Mars, the Mars IEF fund is sort of one that's out there, everyone knows about, that no one talks about, and it was an early stage, and they've had a good impact on the ecosystem. And now you've got their principals or partners spinning off to do a bit later stage, $100 million fund focused on Ontario. So it'll be interesting to see how the market receives them. It's interesting that OMERS, who is a parent company for OMERS Ventures, is investing 25 million in them, because this feels a bit of like an overlap. So it'll be interesting to see what position they have in the Ontario market. Deloitte it'll be interesting to see how the market accepts them as well. Corporate funds can be viewed as great strategic partners, and they explicitly say they don't want to lead and they don't want more than 10% ownership. So they look like the perfect corporate venture capital partner. It'll be interesting to see how they react to the market, because they're looking at checks of 2 to 10 million for companies that have reached 2 million ARR. So it'll It'll be I'm looking to see what they do in first checks, and then Builders VC is a really reputable VC.
Yeah.
I'm really happy to have them investing more in the Canadian market.
So, I mean, the public markets are crushing valuations, as you said. So why are these funds still being announced?
Well, there's a it could be viewed as a bug, but it's actually featured in private markets. The valuations are not updated until something material happens. So every day you look at Shopify and it changes price between 9 and 5 and after hours, and it's constantly being reevaluated. The private markets, you only change the price of a holding when something significant happens. So it goes bankrupt, it raises more funds, it gets acquired. So you don't have that volatility in the markets. So the mindset is different. And it takes time to react to what's going on in the public markets. First of all, the public markets have gone down for a month, but we don't know if there's a permanent reevaluating of companies. If a year from now all these companies are still down, you're going to start seeing the impact. It takes time for those companies to change the mindset of investors. First of all, you'll see downward pressure on the later stage companies. So the companies are just raising to go pre-IPO rounds. If they can't go public at a higher valuation than they invest in, eventually those companies will have pressure to put their prices down in the next round of financing. Then the earlier stages takes even longer because you have to see the impact. It could take 12 to 18 months to start seeing the pressure on early stage, because at early stage, you're still investing to reach $1 billion, and now it's 800 million. Well, it's not a huge difference in a $10 million investment, but once you start doing the math and people start seeing what's happening, there'll be downward pressure. So if you see the public markets be like this for 12 to 18 months, I think you'll start seeing it early stages. Another thing is VC funds have raised a lot of capital in the last year and a half, and they're still raising a lot of capital, and they have an incentive to deploy that capital. So if the supposed supply of great startups remains scarce, there is pressure, to get into the right deals. You'll still pay up for them. So it just might mean you hurt your returns. So the cash in the system takes time to work out.
Right. And then, of course, like thinking back to the founders and their teams, what are some of the implications for them specifically?
Well, first is a counterintuitive one. I think we've talked a lot in the last probably 6 months about how hard it's to hire, how much
Yeah.
prices have gone up. Well, if you're an early stage founder, you may have a unique opportunity to go target the people you want at later stage companies. Going back to public companies are down 30%. So for lots of tech companies, the compensation packages, a lot of his options are restricted stock units. So the public companies, they've already seen the employees drop 30%. They're probably underwater and that stock's not worth money. So part of their compensation's down. Also, the late stage tech companies that were hoping to go public in the next 24 months, those employees that joined the last 24 months might be saying, well, there's not much upside right now with the current valuations. So if I'm an early stage employee, an early stage team or founder and looking for employees, I'd be start targeting people those that joined a big late stage company or public company in the last 24 months, because their compensation or opportunity cost of changing is probably less. On the funding and valuation side,
Mhm.
it's a different question. It depends on a few things. The stage of your company, the last valuation you raised that compared to current valuations, and then the cash on hand. I'd say if you're a late stage company with a valuation that seems a bit rich, and not much cash, I'd be on the market trying to raise a bit of buffer right now at as good valuation as you can, so you can get through the next 18 months. If you're earlier stage, you're probably less impacted. You may even see no impact if you're in a hot area like climate tech, but you should be more picky about the investors you have in your round, because those investors may not have dry powder or be around in 18 months to support you. And if the markets are still choppy, you want partners that are there and going to back you as long as you can. And finally, for potential employees,
Mhm.
make sure you understand how much runway a company has and the valuation that the options are being priced at, to better understand what the risk you're taking at and what your total compensation package may look like. And if you were always worried about the risk of going to an early stage company, you may now face even less risk in an early stage company. So counterintuitively, it might be a better time, and the opportunity cost of going to a really early stage company maybe less. So be bold and go for something you're passionate with, and make sure you know what you're getting into.
I love that. And I think those are really valuable takeaways for everyone that's listening. If you're a fan of those takeaways and you want to keep up, of course, with what's going on in the Canadian tech ecosystem, you have to subscribe to our TechTO newsletter. Alex, what are you excited to read about in tomorrow's edition?
Well, I think we might be covering some stuff about some incubators or accelerators or new VCs, and just what we're talking about. If you need to go raise capital, it's always good that we're putting the light on some new sources of capital and new programs out there.
Yep. I'm also really excited to read about those features as well. And as always, you can subscribe on our website at techto.org/newsletter or look for the link in our bio on all our social media. Next topic for you, Alex. Centralized crypto banking is becoming more competitive in Canada. Why? What is the news with this?
So before I get into that, Alex, do you have any crypto or hold any crypto?
I do not.
So maybe this might be relevant for you. I'd love to hear your
Okay.
thoughts. And then
Yeah.
so Montreal-based ShakePay raised $44 million, led by QED, which is one of the best fintech investors out there, with participation from Boost VC, Box One Ventures, Golden Ventures, and angels like Mike Murchison, founder of Ada, Javan McDonald, Dan DeBow, and Farhan Tawar. And the company raised at a $313 million valuation.
Wow.
So maybe maybe in case you don't know what ShakePay does, and this is why it might be interesting for you to check it out.
Yeah.
ShakePay is a centralized exchange for Bitcoin with a unique UI. So they've built the user experience to be super simple. They motivate people. Apparently, if you shake it every day, you get some satoshis, which is like 1/1,000,000th of a Bitcoin, and
Makes it fun.
it makes it fun,
Makes it fun.
right? And it's a very simple, easy user interface that lets you to onboard to owning Bitcoin very easy. It doesn't try to do it's not an exchange where you can go get 100 different currencies. It doesn't have all these different options. It simplifies it to make it easy to onboard to Bitcoin.
Right.
So and they also offer a prepaid Visa, which gives you 1% back in Bitcoin. Another very simple way to get Bitcoin. And supposedly they've got 900,000 plus Canadians using the service. So very, very simple approach to getting onto Bitcoin. So I'd love after this, maybe next week you can report back if you checked it out.
Will do. And I think that's the challenge with it too, right? Is you don't really know necessarily how to get involved or even just like the best way to approach it or just even understand sort of what's going on. So this sounds like a really great way to make it fun and to just kind of dip your toe in the water a little bit.
Yeah, and I think it has a lot to do with why they're successful. So you look at this company and you go, okay, maybe I haven't heard of, maybe one of the 900,000 people has used them, but I don't think they were a big name in the Canadian ecosystem before. And so if I look at why they've succeeded, I think they've done a few things that are unique. First of all, they have a rising tide, much more interest in Bitcoin and crypto than there was 2 years ago. They have a great user interface. It's only focused on Bitcoin. It's super simple, as I said. The team's super scrappy. They raised $1 million before this in 2015. So you're talking about 6 years with $1 million. So they probably aren't out there spending money on stuff they don't need to. And when you look at their history, they've listened to their customers. They started off doing a few different things, and they realized the thing we need to focus on is make it super easy to own Bitcoin.
And what is, I guess, uniquely Canadian about this?
So if you look at the US, you have several large fintechs where you can buy and sell crypto. You have Coinbase, you have Robinhood, and if that's spring to mind, everyone probably knows who they are. None of them have entered Canada, and a few reasons, but one of this, the Canadian regulators have been not quick to establish rules on crypto, so it's made it hard to know what you can and can't do. So what has happened in Canada, you have a more fragmented market, and most of the crypto companies have been historically undercapitalized for the consumer market. And then the booming crypto combined with a bit more proactive regulatory frameworks emerging, you're starting to see several of these Canadian crypto consumer companies raise massive rounds. So I think unlike the States where you had a couple early winners that have taken lots of mind share and probably market share, you've got a lot of interesting competitors here that have gotten big, relatively speaking, and are raising big money. And it's going to be a much more, I think, competitive market, which is usually the opposite of what we see in Canada. Usually we're less competitive in the States.
So last couple questions for you. Key takeaways for the crypto market and also key lessons for the community.
So yeah, starting with the crypto market, you hear Web3. We've talked a lot about it. We've talked a lot about crypto over the last 6 months or a year or 2 years. I don't know. It just seems like we're always talking about it. And one of the core hard crypto fanatics, Web3 fanatics say this is changing everything because it's decentralized. There won't be a centralized choke point. And what we're seeing is there's benefits to a centralized choke point. ShakePay is working because it's someone making decisions about UI and UX, making it accessible to the mass market. So there's benefits to decentralization, but lots of the market needs centralization and wants people to work it out and help them understand everything. Not everyone wants to be doing everything themselves. Now, this may change over time, but right now there's still opportunities for a company like ShakePay. I think for the community, there's a few takeaways. First of all, regulation has a major impact on new markets. Founders don't talk about regulation. They don't really think about politics, and generally hate. Most of them, I think, hate talking about it. But a clear set of rules make it easier to build a company and lead to less competition down the road. So if I'm a founder, there's an already be founded markets where regulation is about to be formed or is changing. So and sometimes you can help force the change, like in Uber and Lyft's case, but regulation actually creates new blue space. Second of all, user experience is undervalued and can lead to mass market adoption of something that is being only adopted by the bleeding edge of consumers. Web3 is still early, and I think customers and founders still don't know what they want. And if you could figure out what customers want and how they want to interact with Web3, there's a massive opportunity. And finally, just reinforces with these angels. Angel investors are participating in larger and larger rounds. This is a trend we've seen over 6 months, 12 months, maybe 36 months in the States. But the last 6 months, we're seeing that more and more in Canada. So even if you're raising a valuation that's 9 figures, you should still be talking to angels.
And one thing that makes this particularly appealing to someone like me is what you said. It makes it accessible. So I know what I'm going to do after this. I'm going to have to check them out because that sounds really interesting. So thank you for breaking that down for us and our community. Shifting gears a little bit, our next topic that we want to hit on, easiest way to enter new geographies can be via acquisition. What does this mean? And can you break this down for us?
Well, so here, what prompted this idea is Victoria-based Certain acquired Credence, a background check solution company from the UK. And just a bit more here. Credence has a similar product to Certain, and they had distribution or customers in Europe, Middle East, and Africa. So, I could, should we talk about why Certain did this, or how they could do this? Maybe will that help?
Yeah, like let's hit on the why exactly.
Okay, so why? So I think let's go deeper into the why. Certain, was able to raise capital because they grew super quickly. And you know what? When you're growing super quickly and you raise capital, what you have to continue to do, you have to continue growing fast. And their product was sort of has significant barriers to enter every new country, from regulations, from infrastructure. So they were probably looking at, like, how do we enter Europe, the Middle East, Africa, and they did a buy versus build, and it was probably cheaper and faster to buy a company, in this case Credence, than it was build. Now the question is, why were they positioned to do this? Well, they've raised lots of money, they have a high valuation, so their stocks trades at is at a premium compared to competitors. I looked at Credence, I don't see them having made any announcements about raising money. Looks like they maybe bootstrapped or had a small round. So you've got a company like Certain that needs to grow quickly, has a lot of cash, has an equity that's super valuable, and they can go buy Credence either for cash or an equity, and it's a plus for both parties. Credence gets an exit and may be able to share the continued growth of the overall company, and Certain is able to enter a new market relatively cost effectively.
Right. And that was hitting on more of the strategic rationale for them is growing quickly and, cost effective, faster way to build. What are the takeaways for our community on this?
So let's understand a bit more the industry that Certain was working in. You've got some SaaS companies which, can go globally by localizing, by just changing the language and adding payments, different payment methods. A service, and many services like this, when you try to go international, you have to worry about different infrastructure, different regulations, different distribution, plus the language, and so it's hard to be global. And actually, one of the downsides to that is you could be quickly say, oh, this is a Canada only opportunity. And you have to show global ambitions and show the ability to grow quickly. But if you can do that and you can say, hey, this is something that has a lot of problems entering new geographies, but we can do in Canada, we can do in the States, we're super fast, we can go faster than competitors, we're a great team. You can have the capital and the stock that allows you to grow by acquiring companies globally. So, hey, because there might be lots of competitors doing it. Like, look, another example right now, Clearco has competitors popping up in Venezuela, or not Venezuela, but Latin America, Asia, Africa, because there's enough differences that it's not easy just to put like a new language on it and the different payments, like versus something like Airbnb, which there is difficulties, but it's much easier to go global. So there is an opportunity in these markets to get a competitive advantage of capital. The interesting thing is historically you used to have companies like this, people like the Sommer brothers build local knockoffs and then sell them for this reason. So they made early versions of European versions of eBay and Groupon. They sold to eBay and Groupon. And that has now not looked as favorably. What people rather buy is companies that are trying to compete with you and be global players. So you have a different, because culturally there's a more alignment. And look, I just hope more companies take this playbook and Canadian startups end up buying into new markets and keep on growing quickly.
Yep. And I think it's crazy how you've broken it down, and it actually is quite simple when you do actually pay attention to this kind of playbook and these decisions. It's time for my favorite part of quick takes. Are you ready for lightning round?
Sure, let's go.
Okay, funding news. Shoplazza raises 150 million US dollars from SoftBank Vision Fund. Your takeaway?
So, have you ever heard of Shoplazza?
I haven't.
So I haven't either, and it's
Okay,
just,
that makes me feel better.
and they're based in Markham. It
Okay.
offers what's called a headless DTC platform or e-commerce platform. So like think of Shopify, but a bit more flexible. It seems to compete with Shopify, has partnered with like lots of credible companies like Facebook, Google, PayPal, Klarna. And they seem to have a strong presence in helping companies sell into China, like North American companies sell into China. My takeaway here is e-commerce is bigger than we think. Like we think e-commerce is big, but it's still bigger. And I'm not exactly sure if what's actually done in Canada versus what's done in Asia, but this goes back to what we were discussing last week, where Canadian companies are better positioned politically to enter China than America. We're not in the best position with China right now, but we're still in the less competitive. So, I think there's a lot more companies that have a Canadian presence that have penetrated China. We just don't talk about them, and it's still a big opportunity, I think.
Right. Continuing on with the funding news, BenchSci raised as well 50 million US dollars, led by Innovia and TCV. Your
Yes.
takeaway on this one?
So BenchSci is a interesting story. They're a product of CDL Toronto. As Leon, the CEO, joined the company via the program, so it shows you the value add of these different programs. Because I think BenchSci would not be where they are without Leon.
Mm-hmm.
They're proof that the AI machine learning buzz and about the Canadian market is true. It's taken them about 6-7 years, but they're now becoming massive, and it is truly an AI company. The other thing which we know is the company had difficulty raising. I think it was the A round, and Leon had to change his approach to fundraising for all future rounds as being much more successful. And Leon explained that on the TechTO live stream in the past, and he's blogged about it. So I think there's, won't go into now, but anyone who's listening to this and it's interested in like some tips on how to fundraise should go listen to Leon's live stream. I don't know, maybe we'll put a link in it in the show notes.
Yeah, maybe we'll include it in the newsletter for tomorrow too.
Yeah, excellent. So
okay. Sorry, did you have anything else you wanted to say?
No.
Okay, then last one in the lightning round, Caribou's raise, 3 million US dollars, led by Altman Brothers and a bunch of angels. So what's your takeaway?
So Caribou is helping financial advisors provide healthcare planning to clients. Like ShakePay, this shows that the tech community can live a bit of in a bubble. If you ask them about ShakePay, they'd say crypto's all decentralized. You don't need a centralized exchange. If you ask startup founders about their approach to investing in public markets, they say it's probably either there's going to be complicated ways, or you can access the market yourself and use something like Robinhood with some tools to programmatically invest, or you use something like Wealthsimple, which invests on your behalf. But the fact is that there's millions of people in middle America that rely on financial advisors to help them with their financial planning, and they're not going away soon. What is true is that the expectations of that market and what the financial advisors have to provide to keep their clients happy is changing. And that creates opportunities for startups. So in particular, Caribou's helping financial advisors help with something that has a huge financial impact on their clients. So when you look at it, just because the tech market thinks of something doesn't mean it's true. And there's a lot of opportunities in what's counterintuitive to people that live and work and live and participate in this community day after day.
Well, that's certainly a lot to digest with everything that happened this week in Canadian tech. A lot of takeaways. It was good. I feel like it was a very eventful first quick takes for me.
Yeah, Alex, thank you for making it smooth. And, I'm happy anytime Jason can't show up, I'm hoping that you can host.
It's big shoes to fill, but it was a lot of fun, and you're a really great co-host. So thank you. Again, what a week. So much news to take in. You can see a full rundown of everything in our newsletter going out tomorrow. If you haven't already, like and subscribe to TechTO wherever you're watching, and we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.